All right, welcome to the December 19th edition of the Fast Fuels and Oils webinar. This is the last webinar for the year. And so if I forget to say it at the end, which is entirely possible, thank you for all your support this year. Really, really appreciate it. And I hope everybody has a wonderful holiday season. And I look forward to working with everybody in 2024. All right. So just a quick update on South American crop progress. The planting in Brazil is essentially done and conditions are improving. If you look at the weather forecasts, it suggests moderate temperatures in Brazil and a very much more summer-like pattern, particularly for Mato Grosso, where a little bit of rain is forecast nearly every day in the forecast period. Not much, but the accumulation of that rainfall should help recharge soil moisture levels, especially with temperatures not forecast to be as hot as they have been. If this is the beginning of a new trend in the growing season, then I think probably expectations for Brazilian production will start to rise. One of the best meteorologists that I ever worked with had this kind of theory that was essentially you get changes in weather patterns, or maybe more accurately, changes in weather patterns that stick generally tend to occur sometimes around the solstice, because if you think about there's a great graph I saw one time, or illustration I saw one time, that showed sort of the sun and the earth, and you know how as the earth rotates around the sun, we get different seasons because of the tilt of the earth. And so the summer and the winter solstice are when the sun is the most energetic in the northern hemisphere and the most energetic in the southern hemisphere, or provides the most energy to that region of the world, or that hemisphere, I guess. And so the theory sort of was that as you approach those dates, which is coming up in 3 days, I guess, for the winter solstice, as you approach those dates, because you now have the full focus of the sun, essentially, that if you get changes in weather patterns around that time, they tend to be a little stickier than if not. No, I don't know that that this meteorologist had done a huge study on this or anything like that, but he was seriously the best meteorologist that I ever worked with, and I always paid very close attention to what he said. So hopefully for Brazilian farmers and Argentinian farmers as well, the change that we're seeing now will stick around, and that will improve yields. In southern Brazil slash Argentina, I actually took a picture of the radar because the storm is back again, or it was yesterday. I didn't include it in this week's presentation because we're going to talk about tallow, but that weather pattern has stuck, and so we'll see if the change in the weather pattern in central Brazil also has an impact on southern Brazil. As we talked about last week, Argentine crops are in better condition than I would have expected. And so really, if the trend in Argentina just kind of stays the way that it is, farmers there should do fairly well. I don't know that conditions are good enough yet that expectations for Argentinian production will rise above sort of 50 million tons. But either way, even if we just get back to sort of the original expectations for the production this year, it still represents nearly 1.5 billion bushels of additional world production just out of 3 South American countries this year, which should well weigh on soybean prices, especially if, as has been the case, the soy corn ratio remains really in favor of soybeans through February, and the revenue insurance rates are set at a ratio that would favor soybean acreage. Now, we talked about this recently in whether farmers actually switch a bunch of acreage to soybeans or not will remain a mystery right up until the June 30th acreage report next year. But there are early indications, really early indications that that farmers may plant more soybeans next year than they did this year. Farmers typically make a lot of their input decisions going into the end of the year because they can then use those purchases to offset revenue in that crop year. And so even though they probably really won't kind of finalize their plans, well, they won't finalize their plans until they're done planting, essentially, but finalize their initial plans or their intentions until after the February average is determined. There are some early things that they do that will have an impact on what that initial planning is, and the ratio of prices right now as they go to buy inputs for next year is one of those early things. Corn takes a lot more fertilizer and than soybeans, and so if farmers are going to plant a lot of corn, they wouldn't need to, but they would probably start to think about that and start to get prices for fertilizer and maybe order some fertilizer already. So if the price trend continues and we have a good South American crop, and then it looks like U.S. farmers are going to increase soybean acreage, I will be really surprised if we don't see another leg down in soybean prices. They've been hanging in around 13, but we expect them to go lower. And as they do, it makes it increasingly difficult for soybean oil to stay at current levels or rally above current levels, despite the fact that fundamentals remain relatively bullish. Okay, so this week, what I wanted to do, hopefully to keep this a little short, because I'm sure if you're like me, you probably haven't done any Christmas shopping and you may need to. So we'll try and keep this a little shorter today than usual. What we're going to talk about is tallow. So a couple weeks ago, I mentioned in the webinar that I had gotten some questions about the EIA data for tallow for August and September, the big increase in tallow usage in biomass-based diesel production. It essentially doubled from July to September. It nearly doubled from July to August, but from July to September, it doubled from roughly 250 million pounds to more than 500 million pounds. And all of the questions that I got were along the lines of, is that right? Is it sustainable? Initially, it didn't look to me like it was sustainable. And I still think that that there's a good chance that either the USDA is going to have to revise their production numbers, the Census Bureau is going to have to revise their trade flow numbers, or the EIA is going to have to revise their feedstock demand numbers. However, if you look at tallow, all of the tallows together, or I guess inedible and edible tallow combined, there is a way that it sort of works, but it probably isn't that sustainable. So let's get into it. All right, so this shows monthly tallow use in biomass-based diesel production. You can see the huge jump in August and September. I've asked around to see if anybody on our price reporting side knew of a new facility opening or something that would explain this. And I didn't really get any firm, this is what it is, go look it up on the internet kind of answers. I got a couple of, well, you know, this company takes a lot of material, and so maybe it's them, or this company is come back and maybe they've switched their feedstock mix a little bit from our assumptions. it still is, if we make sort of two assumptions, one, that the bulk of the increase is due to renewable diesel production, and then two, that well, we just make that one assumption, let's say. If we do that, the way that we sort of model feedstock demand and predict feedstock demand is by having a little model for each company that includes the feedstock mix for each company. And then we sort of sum those up to get an implied national feedstock mix and multiply that feedstock mix by production to get feedstock use. If we cram as much tallow into the facilities that have announced that they're using tallow and are open and producing as we can, it still is extraordinarily tough to get to the numbers that USDA or that the EIA has provided here. About the most that we can stuff into renewable diesel is maybe 350 or 400 million pounds. And so the other 150 could easily be going into biodiesel production. And it would be more than we'd seen in biodiesel production before, but there just isn't that much space in renewable diesel for us to get the numbers, to replicate EIA's numbers. Plus, it doesn't necessarily make a ton of sense to me. Doesn't mean it's not happening, but it doesn't make a ton of sense to me that you'd see a big increase in tallow use in biodiesel at the same time you saw a big increase in tallow use in renewable diesel. It seems much more likely that it's one or the other, and that it's probably one facility, or there's a coincidence where there's one facility that accounts for the majority of the increase, and then there's a second facility that has increased its usage by some amount that just sort of put it way over the top. And one or both of those facilities would almost have to be running 100% tallow for us to get to the numbers that the EIA reported. Now, you can see from our forecast that we haven't fully bought into the idea that that tallow is going to continue at this volume month after month, partially because it's such a large portion of supply and the non-biofuel demand for tallow has been so strong that it's hard for me just to make the numbers work in the spreadsheets if we take tallow up to 500 million pounds a month. Now, I would probably bet a fair amount of money that the EIA will report 500 plus million pounds of usage, or roughly 500 million pounds of usage for October and maybe November and December as well. And as that happens, we will refine our models and try to figure out exactly where this tallow is going. But in the interim, I ask for a little bit of patience while we try to adjust to this. The last thing that I really want to do is increase our forecast based on a couple of months. In fair enough, the EIA isn't an agency that usually makes big changes in their estimates and then sort of reverses those changes after a couple of months, similar to the way that USDA does their forecast. The EIA doesn't want to whip the market around with its data. So even though it seems more than likely that we will continue to use 500 million pounds of tallow, until we have a better grip on why, where, it's hard for me to forecast that usage. While at the same time, I do recognize that it seems extremely likely that it's going to happen. So I say, please take the forecast right now for tallow, the tallow balance sheets, with a grain of salt. And as soon as we kind of figure this puzzle out, and it's something that this isn't something we just started working on last week. This is something that we've been working on and thinking about for a while. The main reason that we are talking about it today is, well, one, it's the last week of the year and there isn't that much else to talk about, but also because because the questions have been persistent, and the EIA followed up August with September. And so I think that there probably needs to be a little bit of an analysis here, and sharing it with you hopefully will help shed some light on exactly what's going on. The last thing I'll say about this is, despite the fact that we're not going 500 million pounds a month, we still do have, I think a little bit of an increase in feedstock usage built in year to year. Even if we have a bit of a decrease, it's just, if you look at 2022 usage, then 2023 usage, 2024 usage will be in line with sort of the trend in 2022, at least until ultimately we change our forecast to reflect whatever it is that we understand that's going on here. So recently, the EIA has started to report vegetable oil use by fuel. They haven't quite started that breakout for fats and greases yet, and I don't know if they will. I hope they do. But in the interim, the way that we have to split up the EIA's feedstock data is by going through the process that I described before. The only difference is that now we have a complete picture of what the feedstock usage theoretically was during the month, and we have the history that we can compare our estimates to. So the way that we break up the EIA fat and grease feedstock data is we adjust for renewable diesel first, and we make that seem reasonable. So in this case, what reasonable would have been for renewable diesel is roughly 150, 160 million pounds a month. And for biodiesel, call it 100 million pounds a month. So obviously, when you go from 250 million pounds to 500 million pounds in 2 months, it doesn't give you a lot of reference to split the fuels or split the feedstock use between the fuels. And in that case, what we do is we do something that unfortunately is a conservative approach, but probably also the approach that's most likely to be wrong. And that is, we make renewable diesel look relatively reasonable. We look at what that implies for biodiesel use, and then we sort of, if biodiesel use doesn't look reasonable at that point, we sort of continue to split the difference until either they both look reasonable, one of them looks reasonable, or, as is the case with this one, we get to a spot where continuing to kind of play with the numbers doesn't really necessarily make sense. Now, again, I think that at some point, either one of the agencies will come back and adjust their numbers, or we're going to go back and adjust our numbers. I would guess ultimately that what we'll find out is that there isn't a renewable diesel facility that is using a lot of tallow. And so ultimately, I think that this means that the tallow used in biodiesel production probably will come down. Tallow used in renewable diesel production probably will go up. The key question will be, what does that mean going forward? If that is the case, if it's biodiesel down, renewable diesel up, then I think it's relatively easy to kind of extend that into the future, assuming that that facility will continue to use tallow unless there is a significant deviation in the spread between tallow and other feedstocks, and that it starts to look like using tallow just doesn't make any economic sense whatsoever. And then in that case, then we'll go back to whatever our old feedstock mix for that facility was. Either way, I think that the sharp increase in tallow probably foreshadows what could happen in some of the other feedstocks, both sort of up and down, I think, in terms of month over month changes in the volume. As margins for both renewable diesel producers and biodiesel producers narrow, the substitutability and the competitiveness of individual feedstocks will become increasingly important. And I think that facilities will become much more likely to change feedstocks than they are when biodiesel is making $1 a gallon and renewable diesel is making $2 a gallon, or we estimate that it's making $1 and $2 a gallon. And I think that this will lead to more volatility in again the month-to-month estimates of feedstock use, and that'll then in turn make a little bit more volatility in at least the individual commodity markets. So a little bit more volatile in tallow or in choice white grease or whatever. When that volatility for a single commodity makes the spread between that commodity and other commodities such that it's just sort of economically ridiculous to continue to use it, I think you could get situations where you see sort of the opposite of this, where tallow goes from 500 million pounds of use down to 100 or no, 200 or 300 million pounds. Maybe even that's a little low. But surprising given what we've seen over the last couple of years, which has generally just been a steady increase in feedstock consumption. It seems like recently the sharp increase in tallow use in biomass-based diesel production notwithstanding, it seems like recently that we are the biomass-based diesel industry is getting relatively close to using up the available supply of fats and greases in biomass-based diesel production. I don't mean that there's not anything left anywhere, but like we saw with tallow, what that generally implies is that for biomass-based diesel feedstock use to increase, you're going to have to decrease use in non-biofuel usage. And that is something that I think most analysts have expected for a while, given the projections in feedstock demand. It's not hard if you just run those out for a year or two to get to a point where you have to make a decision about how to allocate the supply, whether more is going to go to renewable diesel, biodiesel, or non-biofuel use. And over the last couple months, it seems like that I can't think of the word, that scenario is not quite it, but that scenario is more common in the feedstocks, particularly the more popular feedstocks like tallow, than it has over the last couple of years. Now, again, this is something that I have predicted the reduction in non-biofuel use. I predicted each year for the last 2 years across a lot of these commodities. And of course, like a lot of things in commodity markets or financial markets generally, just about the time as an analyst that you give up on an idea is the time that something happens and sort of confirms it. And so the move with tallow and the feedstock use with tallow, taking down non-biofuel use in some ways confirms that idea, assuming that all the numbers are correct. And it's likely that as you sort of max out the usage relative to the supply of one feedstock, while feedstock demand is still growing, what happens is then the rest of the industry, let's say it's just one facility that's using all the tallow, the rest of the industry has to pivot to another feedstock. And so what I would assume would really make me believe that we are at the very edge of using all of the consumable supply is more data points like this, where you get just big increases in sort of the other popular feedstocks, and they're driven by this limited supply of tallow, or whatever. So I'm a renewable diesel producer that uses tallow. My competitor just bought the next 2 months worth of tallow supply to produce renewable diesel. I've got to go find something else. And so I switched sort of wholeheartedly to the other feedstock that I was using, used cooking oil or soybean oil or choice white grease. Choice white grease is one of the less popular ones, but that kind of thing. So if we see more of this kind of reporting from the EIA, I think the key takeaway is that we really are very close to consuming the supply or the available supply of low CI feedstocks in the US. This always seemed like it was going to happen. The rapid growth in renewable diesel capacity and the relatively fixed supply of these fats and greases almost assured that it was going to happen. It was just a question of when. And that was something that was always a little hard to forecast, especially if you're taking non-biofuel use down, because you can always sort of fit it all in. The tough part about taking non-biofuel use down, though, is that in most cases, and I said this so many times on this call, but I'll say it again because it is really important. In most cases, non-biofuel end users can afford to pay more for the commodity than biofuel producers can, even with credit values and all of that, because for biofuel producers, feedstock costs are like 85% or something of total costs. Whereas for somebody that's making shampoo or salad dressing, mayonnaise is super soybean oil intensive. Mayonnaise might be a little bit closer to that, although I doubt it really. But in all of those cases, the cost of the commodity, the cost of the vegetable oil, fat, or grease is just a very small portion of the overall cost. I worked at a fast food restaurant for a little while when I was younger, and the owner happened to be a neighbor of ours. And so I got to talk to him about the business and how it ran and sort of what it looked like on the other side of the counter. And one of the things that really surprised me was that he said, when you go to buy a Coke, of course, the cost of the cup is way, way more than the cost of the Coke in the cup. And that is kind of the same thing that's going on here, where container cost, marketing cost, all of those costs all add up, and the commodity cost is just a small portion. And so while commodity consumer goods producers are under intense pressure not to raise prices just from the competition, they will only have to raise prices modestly, if at all, based on the increase in vegetable oil, fat, or grease prices. So they should be able to pay a lot more for that commodity than a biomass-based diesel producer. Now, there's a bunch of other variables, and that's a really, really simplified version of how that all works. But I think part of the reason that non-biofuel demand has been so sticky is because of that situation, because non-biofuel users can, and there has been enough supply that biofuel and non-biofuel users could all have as much as they want. If we're shifting from there, if our pattern is shifting much in the same way that the weather is in Brazil, then we will see these kinds of weird reports from the EIA every month, where all of a sudden we start to use a lot of choice weight grease instead of the sort of declining feedstock demand that we've seen over the last year or two. And the non-biofuel users will find either other feedstock commodities to substitute for their for whatever their commodity of choice is, or they will find non-feedstock commodities like palm oil and use that instead. If you look at US imports of palm oil, they've risen really sharply, and that has a lot to do with substitution, because the feedstock commodities are going, there's so much of them being used in biomass-based diesel production at this point. That trend will likely continue and accelerate in 2024. What happens in 2025 will be interesting, because in theory, the IRA credit will shut down vegetable oil consumption for biofuel feedstock, but I'm not 100% sure that I think that's going to happen. It's well, it will be very tough to reach the goals of the renewable fuel programs if we eliminate vegetable oil from the feedstock mix. And so because of that, I think either RIN prices will offset the decline in revenue from the blender's tax credit, the switch from the blender's tax credit to the Inflation Reduction Act credits, or something else will happen. Fat and grease prices will rise enough that vegetable oil the cost of vegetable oil offsets the lost revenue and margins. There will be something that will happen that will make vegetable oils continue to be included in the feedstock mix, unless they become expressly prohibited in the same way that they are in Europe. They're not prohibited, but the volume is frozen, and it sort of shrinks every year. All right, so if we look at tallow production, and I didn't include the chart that I wanted to right here. I didn't think about it until I was just sitting down to do this. This is actually, I think this is actually inedible tallow production. And so if you look at inedible tallow production, then it doesn't look like we produce enough to even meet the demand from the biomass-based diesel production, let alone any trade flows or any exports or non-biofuel use. Now, if we add edible onto it, and then we add imports, which we all know have surged and look a lot like this, then what we get is a supply of about 700 million pounds in September. So 700 million pounds against feedstock use of 500 million leaves 200 million pounds for changes in stocks, exports, and non-biofuel use. Exports ran about 30 million pounds in September, I think. And so that left non-biofuel use around 150 or so million pounds, a little bit less than that, I think, in September. That's a big decrease from where non-biofuel use was in July. And from that, so to sort of answer the question, is this sustainable? There's kind of two ways to look at it. One is just, do we have enough of this stuff to meet the demand that the EIA is presenting going forward without having to make any other changes? And even at 700 million pounds of supplies, which again includes import, but even at 700 million pounds, it doesn't seem likely that that is a sustainable rate of consumption from the biomass-based diesel industry, just because the amount that's left over for non-biofuel use is so small. And again, non-biofuel users can pay more for this stuff. Now, the opposite side of that argument is that biofuel producers are mandated by law to produce enough biofuel to meet their obligations. They can carry those obligations over for a year, and they may have some carryover rents, and there's all that kind of stuff that goes around it. But just sort of stripped down to the bare minimum argument, they have to produce biodiesel every year or biomass-based diesel every year, beyond the financial needs and all of that. The law requires them to produce biomass-based diesel every year. And so even though, and I think this is probably a bit of the case with tallow, even though non-biofuel users can pay more, biofuel producers have to have it. And so at some point, they just have to pay more if they're going to remain in business. And I think that what we'll see going forward is that the trade flows that we've seen over the last couple of years shift to the US becoming a net importer will continue to accelerate. And that will have a couple of impacts on the industry. It will, of course, provide a lot more supply. And if we look at tallow imports now, you can see how much they've grown relative to the 5-year average over the last couple of years. So the first is the most obvious and easiest. We'll have a lot more supply. The second is that at least initially, I guess, is the way I want to put this. At least initially, the diversification of sources of tallow or other feedstocks will make the supply chain a little bit more stable, or make the supply of feedstock a little bit more stable. Because if you have a turn in the cattle cycle like you've had in the US, if you look at what I should say is, somebody said, I heard, I haven't really confirmed this myself, if you look at the Australian cattle cycle, it's at the opposite end of the cycle from the US. So while the US slaughter is declining, Australian slaughter is increasing. I don't know if that's true, but that's the kind of thing that sort of stabilizes the supply chain. The problem with that is that I believe eventually most developed countries will have a sustainable aviation fuel mandate. And as soon as they have that mandate, all of those exporters will be encouraged to not export whatever commodity they're exporting, and instead sell it to the new domestic renewable fuel industry. Governments will encourage this because it allows the country's economy to capture more of the value of the commodity. And in these cases, a lot of these are sort of waste commodities. And so this is essentially almost like free money for them. So when that happens, there will be a reduction in the available exportable supply in those countries, and that will reduce the supply that's available to the US. If this happens in 2 or 3 years, you'll have had a situation where the supply chain has been built up, reinforced over a couple of years, and then suddenly makes a big pivot away from what had just been built back to where we started. It also means that US feedstock supplies will be cut, and that will make prices more volatile and potentially higher or significantly higher. The one key variable that will determine when that happens, whether feedstock costs explode through the roof or just go up a little bit, or maybe not at all, will be UCO supplies. UCO is the who knows how many billion-pound gorilla sitting in the corner, and the ramp up in US UCO imports, particularly from Asian countries, particularly from China, is at a pace that is much faster than we anticipated. So when we originally set these models up, the way that we estimated UCO production was by taking per capita income and then applying some multiple to that based on whether the country was developing, developed, or in between the two. So developing countries, because the population is not on Maslow's, I think that's the right name, pyramid of needs, collecting UCO to ship to the US to turn into renewable fuel is well above sort of eating meat more than once a year. And so as those countries develop, though, then that becomes more important to the citizens of those countries, and you get the development of renewable fuel programs and things like that. The US renewable fuel program has created a huge economic incentive for developing countries to start to collect UCO and send it to the US. The challenging part is trying to figure out how much UCO there is in these developing countries. So the model that we set up initially worked pretty well, I've got to say, for the last several years at predicting UCO. We did something kind of similar in tallow. Of course, it was modified by cattle slaughter numbers, but still kind of the same concept of renewable fuel production is higher. It comes at higher per capita incomes. But in China really, or the increase in imports from China really sort of broke the model, or broke the mold of the model. It did, well, I should say, it forced us to go back and make some changes to the assumptions about how countries are, or how much UCO countries will collect at different stages of development, to where basically most countries now look like the US in terms of not necessarily per capita production of UCO relative to per capita income, but they're headed that way. We basically use kind of the same multiplier, discounted a little bit, because the industry is young in these developing countries, and the supply chain and logistics aren't as optimized as they are in the US. However, it seems likely that they will get that optimized, and then the question just becomes, how much UCO is there out there? I think one way to do this, and I haven't quite done this yet, but I probably will at some point in the first quarter of 2024. One way to estimate the volume of UCO out there is just look at vegetable oil, fat and grease, world vegetable oil, fat and grease production, and in theory that should almost be the supply of well, not almost, but a big chunk of that should show up as UCO. So whatever we put in mayonnaise and plastics and whatever else gets used, that part wouldn't show up as UCO, but everything else will. So it wouldn't be a bad starting point for UCO production worldwide. And then sort of knock non-biofuel use out of it, and then see how much of that production is available for export. My guess is, in the world, there's probably enough UCO to meet the demand from the US, Europe, and any other country that wants to, well, maybe not any other country, but most other countries that want to, I apologize for my phone going off. Most other countries that want to have a renewable fuel program. We'll see if that's actually true. That's what it seems to be true, and that's kind of what my gut tells me. We're not at that point yet. So if we're just sort of exhausting the US domestic supply of these feedstocks, it'll be a little while before we get to exhausting the world supply of these feedstocks, particularly, I think, UCO. In one of the ways that I think that it is apparent that there's a lot more UCO out there than is being used, or there's a lot more biomass-based diesel feedstock than being used, is that in the European markets, Chinese UCO and then biomass-based diesel imports that were made from low CI feedstocks have really made a substantial dent in the European supply. So much so that it was much more competitive than a lot of the domestically sourced feedstocks. And while I don't know that will happen in the US because the demand is so strong, and it would take such a huge ramp up in imports to get to that point here, in 4 or 5 years, we may be talking about how the US is exporting 2 billion pounds of soybean oil again, because so much of the feedstock demand has gone to UCO. And the switch from the blender's tax credit to the inflation reduction, or the blender's tax credit to the Inflation Reduction Act credits will likely accelerate that process. All right, so where are we getting our tallow imports, and how risky are these sources? Not risky in terms of they're gonna, rob from us, I guess, but risky just in terms of, will the supply be there next year, 5 years from now, 10 years from now? If we look at Canada, Canada has long been a big supplier of tallow to the US. It makes a lot of sense. They're right next to us. And since the introduction of the LCFS and the inclusion of CI scores in credit valuations, a lot of tallow exports have found their way from Canada across the border to the United States. Australia is another long-term, I guess, supplier to the US. Australia's cattle market is well developed, and while it seems unlikely that there would be something that would happen to the Australian tallow supply that would restrict imports to the US, it seems much more likely that a SAF mandate in Australia will suck up all of the tallow supply and limit the exports. And I will be genuinely surprised if within 5 years Australia does not have a SAF mandate, and maybe before that. But I'll be shocked if I'm on this call in January 20 or in December 2028 and Australia still doesn't have a SAF mandate. I'll do a little dance or something really, really embarrassing for anybody that remembers that 5 years from now. Beyond that, New Zealand is similar to Australia. A lot of the same things apply. And while I'm not 100% sure that I think New Zealand would necessarily come up with its own SAF mandate, it might, but they could also get away with probably just mandating that flights in and out of the country use a certain percentage of SAF, and may or may not need to develop their own renewable diesel industry, especially if Australia does it right next door. Now, like all good neighbors, there's a little bit of competition between Australia and New Zealand. And so if Australia has a SAF program, it could also trigger a program in New Zealand. And so I think New Zealand, probably of the couple that we've covered so far, New Zealand is the most risky out of Canada, Australia, and New Zealand, both because tallow production is relatively smaller, and also because there's sort of a double chance for New Zealand supplies to get sucked into a SAF mandate in Oceania. Brazil is a big cattle producer and a big agricultural exporter. Brazil has a biofuel mandate and a long history with the biofuel mandates. So while a SAF mandate on top of the mandates that Brazil already has would take up more of the tallow supply, it wouldn't necessarily, I don't think, restrict it so much that there wasn't any available for the US. Now, Brazil has not traditionally been a huge supplier of tallow to the US, but you can see that over the last couple of years, the portion of US imports that they supply has increased pretty sharply. And that's at a time when US imports were growing pretty dramatically. Argentina, basically the same as Brazil. The most significant risk in Argentina is really economic, given the long history that the country has had with really, really high inflation and the other sort of economic problems that Argentina has had. That said, the country is literally set up to export commodities, and it's the primary way that they earn foreign reserves. So it seems highly unlikely that the Argentinian government would ever enact a mandate or a program that would limit the supply of feedstock that got out of the country However, I will say that they would prefer to. Argentina is the prime example of a country that wanted to capture all of the value from its agricultural industry. And so Argentina's tax structure taxes soybeans at the highest rate, soybean meal and oil at a lower rate than soybeans, and biodiesel at a lower rate than meal and oil, because along each step of the supply chain there's more value that stays in the country. And so that's how other countries may ultimately set up their export taxes if they establish a domestic SAF mandate. But that tax system also was the primary reason that the U.S. was able to effectively tariff Argentinian biodiesel imports into the U.S. and shut off the supply, because the U.S. argued that the export tax structure in Argentina was effectively a subsidy. Subsidy for the Argentinian biomass-based diesel industry, and the courts agreed, and not just U.S. courts. The World Trade Organization didn't strike down U.S. tariffs, and so to the extent that other countries try to imitate Argentina's tax structure, they're at risk of having that happen. Now, Argentina didn't change their tax structure. They're still exporting biodiesel, not to the U.S. They're exporting it to mostly to the European Union at this point, who was the initial recipient of biodiesel when Argentina developed their industry. They put tariffs on Argentina's biodiesel. Ultimately, the World Trade Organization found that those tariffs were not legal, and the two countries entered into an agreement that allowed Argentina to resume exports of biodiesel, but with some regulations around them to keep them from underselling the domestic supplies. Mexico and Uruguay. Uruguay is same as Brazil and Argentina. Mexico is a relatively small and sort of opportunistic supplier of tallow to the U.S. I wouldn't expect Mexican supplies to increase substantially. However, it wouldn't necessarily surprise me if they did. I think Mexico has a fairly substantial cattle/dairy industry, and they should produce enough tallow and don't have a biofuels program, and so all of that tallow should be available, or at least a portion of that tallow should be available for export to the U.S. All right, so what does that mean for non-biofuel use? Like I said, we haven't quite come around to the idea of using 500 million pounds of tallow per month in biomass-based diesel feedstock, but we probably will. In the interim, you can see that we still expect non-biofuel use to remain close to where it has been recently. Again, I would take this prediction more. I wouldn't necessarily take the exact number for this prediction. What I would take is the underlying suggestion of this prediction, which is it seems like non-biofuel use has been stickier than in the past, and until there is a real obvious reason, like we're seeing in tallow, honestly, until there's a real obvious reason for us to change it, the last couple of years have taught us that sticking with non-biofuel use has been the correct way to go. There will come a time when that's not the correct answer. Tallow may be the first indication that we are getting to that point, and whether we cut tallow non-biofuel usage to the bone, or it sort of remains in this range where it's been. You can see sort of from 14-15 to 17-18, you had growth that looks like the growth that you see in a lot of these commodities, in the non-biofuel use of a lot of these commodities, basically in line with economic and population growth. And then things kind of went sideways as we started to build out renewable diesel capacity and feedstock demand grew. And so what I mean by this prediction is probably more along the lines of staying within that range than this actual number. That's kind of it. Now, whether the 2021 peak is the beginning of a downtrend there, that remains to be seen. I wouldn't, if I were not the analyst and I were sitting on the other side of this screen, it if this prediction were closer to 1.9 billion pounds, so sort of in line with that little downtrend there over the last couple of years, that wouldn't necessarily, I wouldn't think that that was necessarily out of bounds. The 2.6 is really, it's the remainder of the supply that's left, based on in part on our feedstock assumptions, which again probably will rise by at least 700 million pounds. That could be monthly usage in October, by 700 million pounds over the next year. All right. So what does that mean for prices? Our price forecast suggests that we are at or close to the bottom of feedstock prices. And I think that's particularly true for the fats and greases. If you look at what fat and grease prices have done, of course, they've dropped a lot in the last several weeks. But before that, they held up fairly well while soybean oil really moved much lower. Soybean oil, as it usually does, moved sharply lower earlier, and then the fats and greases kind of followed a little bit later. Our soybean oil forecast doesn't necessarily look like this, and we would expect that the spread, and I've shown that chart a couple of times on here, the spread between soybean oil and the other feedstocks to narrow from the historically high levels that we've seen over the last couple of years, and our prediction for tallow is part of that. The sharp drop off in the end there is, I'll look at that. My guess is it's because it's coming after October. My guess is that that's just a change in the marketing year. And when we change the marketing year, there are forecasts. There's a couple of different ways that we do forecasts. So longer term forecasts, of course, we don't look at as closely as we do nearby forecasts. A year out, we should be looking at fairly closely, but there are times where at the change of a marketing year, we don't quite, and by we, I mean me, I don't quite carry through the other model to the new one. So I'll adjust that. My guess would be that you would see maybe a little bit of a decline. There's some seasonality in the market at that time, but probably not a drop as sharp as this. The ramp up in prices, that's almost wholly a function of the idea that we are close to the end of the consumable supply of feedstocks. And so if we're going to start to use 500 million pounds of tallow every month in biomass-based diesel, that's going to have a knock-on effect on the other markets. And ultimately, I think that probably helps support all the prices. Now, whether soybean oil can drop as much as we think it might because of the decline in soybean prices, and fat and grease prices can remain well supported, it hasn't. Most of the time, what happens is the fats and greases follow soybean oil with a 4, 6, 8 week lag. And this could be the beginning of the breaking of that relationship, at least for maybe like the next year. After that, we get the switch to the IRA credit, and that's going to create a whole new set of economic incentives, which will disfavor most vegetable oils and favor fats and greases, and will only add to the upside pressure on fat and grease prices, and not necessarily the downside pressure on soybean oil prices, although it certainly would contribute to that. There still is enough demand that I don't think we're going to, like I said, I don't think we're going to export 2 billion pounds of soybean oil from the US again anytime soon. So you could see a split in vegetable oil price, the direction of vegetable oil prices and fat and grease prices, where fat and grease remains well supported through 2024, and vegetable oils are as weak as they can be, while still maintaining some of the relationships to the fat and grease prices that are critical, because you can substitute some of the stuff back and forth. And so if any of those spreads get too far out of line, then that substitution will happen and the spread will come back. In theory, what we've seen with soybean oil spreads over the last 2 years has really been something that I wasn't sure I would see. Not that it's something that I think I sit around and think about, gee, I hope that someday I can see a 20-cent premium for soybean oil over palm oil. Not like that, but I just, while we were going through it and I was trying to predict how high the spreads would go, the spreads went to levels that I never envisioned that they might be able to go to, because it does seem like you should get some substitution in there. And there's a little bit of, the US domestic market versus the world market, so that the US domestic fundamentals don't match world fundamentals. So you get some weird price reactions in US domestic prices. But even with that, I never thought that I would see a 30-cent premium for soybean oil over palm oil that would persist for months at a time. All right. With that, I will. Oh, sorry, I didn't put the timer up today and I went even longer. All right, with that, I truly hope that everybody has a wonderful holiday. I look forward to seeing everybody in January, and I hope that everybody has a lot of good food and fun and enjoys their family or friends or family and friends over the holidays. Bye, everybody.